All right. Well, hello and good afternoon, everybody. My name is Tom Gallucci, Vice President of Business Development with the Mortgage Collaborative, and want to thank everybody for joining today's TMC Connect web broadcast entitled The Life of a Mortgage Loan Playbook. And we are privileged enough to have the co-authors of the playbook here with us today, kind of take you through their findings, as well as extend the opportunity for today's participants to be able to access a free copy of the Life of a Mortgage Loan Playbook ebook. But before we jump into today's presentation, I want to go through some quick housekeeping items related to the call. So just a general reminder out there for our attendees, encourage you to keep checking out our TMC Connect and member event calendar pages, both accessible on the Mortgage Collaborative website, and that's going to give you an up-to-date view of the current TMC Connect web broadcast and what we've got coming down the line. So encourage you to keep checking in as we'll be continuing to add new sessions, primarily based off the feedback that we're getting from you, our members and preferred partners. So keep those great content submissions coming in. For today's discussion, whether you've dialed in or you're connected via your computer, all lines have been muted for the call. And that's done only to avoid any background noise in your areas. We want to assure that all attendees can hear today's presentation clearly. Now, that said, we do want these discussions to be as interactive as possible. So I encourage all attendees, feel free to submit any questions that you may have for our discussion leaders throughout the discussion, and we'll be able to go ahead and verbalize those on your behalf towards the end of our discussion today. So, well, how do you submit those questions? Well, if you're connected via the Zoom screen, you can do so either via the chat or Q&A functions, both of which are accessible at the bottom menu of your screen. Pop up either one of those functions, type in your question, and I'll see those come through on our end, and I'll be able to verbalize those towards the end of the call. Now, that said, if we do run out of time on today's discussion, we'll make sure to screenshot any questions that we don't get to address directly, just so I can facilitate those back out to our discussion leaders to follow up on afterwards. And for our attendees today, the discussion is recorded, so will be accessible for playback, as well as you'll get access to a copy of the ebook, as I mentioned, and that will be presented both in a follow-up correspondence that you should receive tomorrow. So as we jump into today, just want to remind our preferred partners on the line, if you'd like to see myself or Rich Rabinski or anybody else on the team supporting your branded apparel, as I've got my Simple Nexus Game of Loans t-shirt on today, feel free to reach out to Tony Bradley or myself, and we can coordinate with you on getting your brand promoted on our next TMC Connect broadcast. So let's dig into today's discussion. As I mentioned, we're privileged to have the co-authors of The Life of a Mortgage Loan Playbook leading today's discussion. So first up, I want to introduce Brenda Clem, the Chief Product Strategist with our preferred partner at TMC LoanLogix. I think LoanLogix is one of our original partners going back more than 5 years now. So Brenda, in her role, is responsible for developing and implementing strategic plans for all LoanLogix products and understanding and the prioritization of market needs. A little bit about Brenda's history. She's a certified mortgage banker, has more than 30 plus years of experience in residential mortgage operations with strong expertise in secondary marketing, loan delivery, warehouse lending, post-closing quality control, as well as investor relations. And then prior to Brenda's current role, she previously served as EVP of Capital Markets with Pavaso, as well as Director of eClose with Black Knight. And prior to that, Brenda also consulted for the Street Resource Group. So throughout her various roles, over her vast experience within our industry, it's been a consistent focus that's tasked Brenda with planning and developing technology offerings that enable eClose functionality, in addition to education and awareness for both eNote and eMortgage adoption. So in addition to the different hats that Brenda has worn in her experience, she's also a frequent speaker at industry events and has authored several articles for MBA, is a member of several MISMO working groups, and a member of the MORPAC steering committee. So Brenda, pleasure to have you today. Hope you're doing well this afternoon.
And thank you, Tom. Appreciate the opportunity.
Absolutely. So also leading the discussion, we have Linda Aparo, who is the National Director of Sales and Business Development at Require Real Estate Solutions. And a little bit on Linda, she also brings more than 30 years of experience, particularly in title insurance in the real estate industry, working both with underwriters and agencies in different states across the country. Linda's also the founder and CEO of Final Track, a leading release tracking company before its acquisition by Require. And Linda also received her National Title Professional designation back in 2017 and also participates on Real Property Committee, Native American Land Committee, as well as the membership committee for ALTA. And she's also licensed as a real estate agent in both the states of Massachusetts and Connecticut. And Linda also speaks nationally on her ebook, The Life of a Mortgage Loan Playbook, along with the importance of first lien positions. So Linda has an outstanding record of success in identifying business opportunities, developing strategies, creating new products, as well as implementing actions to boost business performance. So Linda, also really great to have you with us today and hope you're doing well, and appreciate you joining our discussion.
Thanks, Tom.
Excellent. Well, on that note, let's dive directly into the discussion. Linda, I'm going to turn it over to you and kind of let you kick things off from here about the playbook itself.
Terrific. Thanks, Tom. Hey, everyone. Coming to you from Connecticut, where I call home and where I have been stuck in my house since March, but enjoying it very much. So Brenda and I got together to write this ebook after attending the American Land Title Association meeting a few years back. And when we were sitting there talking with people, we realized that they did not know what happened in the mortgage industry from before the mortgage ends up in their hands, and from the title industry, what happens after they close that loan, what happens to the papers of that mortgage, and what is the life. So Brenda and I collaborated in putting this ebook together, which you can get at the end of this presentation. And I'm going to start off with the beginning of the mortgage loan, the very beginning when a borrower decides to buy a property. Tony, you can go ahead and go to the next slide. So in the beginning, like Tom had mentioned, I am a realtor in both Connecticut and Massachusetts. So any realtors or people that have relationships with realtors know that a borrower usually decides to buy a house and goes to that realtor to find a house. It's the American dream to own a house. And so once the realtor finds them a house, they have to go through inspections, they have to apply for the loan, they have to get qualified, their application is reviewed by an underwriter, and some statistics which we show in our very visual book is the average new mortgage balance is about $260,000. So that's across the country. That's the average loan balance. 2.17 trillion mortgages were originated in 2019, and 63% of all homeowners have a mortgage on their home. So we are charged with taking care of this property, taking care of the closing, making sure that these people that aren't in our industry are comfortable with their purchase. Once all of this happens, Tony, you can go to the next slide. It goes to the closing table. So closings happen differently in all of the states. There are attorney closings, there are title insurance closings, which are title companies, and then there are escrow companies. So the country is divided up into how the closing process happens, but all of it serves the same purpose. The seller is selling their home, and the buyer is buying their home. If the buyer needs money to purchase that home, then they go and they get a mortgage. Now, the title industry is tasked with coordinating all of that, and it truly is an art, especially with the interest rates being so low, and our real estate market has seen unbelievable increase in refinances, even though it's COVID, which personally has shocked me, but it's all good for our industry. And so all of these closers and closing paralegals have to coordinate everything from the beginning to the end. So they have to order title work, they have to order taxes, they have to check to make sure that the loan that they're paying off, they have the payoff amount, they have to coordinate all of this with the lender and the other side if it's a split state, with the borrower and with the seller to make sure that this closing moves forward. So at that closing, the documents are all explained, and then they sign all of the documents. Once they sign the documents, and then it is the new property is transferred to the new owner. All of the payoffs are made. So when the seller pays off their existing mortgage, they make sure that at that time that mortgage is paid off. All the checks are cut and everything is sent out. The seller receives their money. The realtor, of course, receives their money. The title policy is issued. And then the closing package is packaged up and sent to the lender that has secured that mortgage on the property. Post-closing, after the payoff of the original mortgage that the seller paid off is paid off, then the follow-up has to be done for the lien release to assure that the release is recorded so there's no clouds on title. So now with post-closing, the mortgage, like I said, is recorded, and the American Land Title Association mandates that within 2 days of that closing, that the mortgage be recorded on the land records. The reason for this is because once you close on that loan, they have to make sure there's no intervening liens that are recorded before that mortgage is recorded. So let's say that you have a house and you have creditors that are after you, you end up selling your house. The creditor finds out that your closing is happening. You sign that mortgage, they run into the land records and they file a judgment lien. So that's why Alta mandates that 2-day period. So those judgment liens can't come before the mortgage, because what happens is that judgment lien is now in first lien position and that mortgage is in second lien position. So the person that does that recording of that mortgage has to run down the title to make sure nothing's appearing before it, because the title insurance policy is in fact saying that they're in first lien position. The documents are then all packaged up and sent out to the new mortgage provider. And the statistics here on the bottom of this are astounding. 7.43 missing final closing disclosure statements, and that was per recent securitized sale. 43% missing required documents to complete sale per recent securitized sale. And 17% of the releases are not recorded on the land records after that first mortgage is paid off. So Brenda and I, when we developed this, we wanted to make sure that everybody knew what the process is, excuse me, where they fall in that, and what their jobs are in order to make sure that when that mortgage closes and moves on, which Brenda's going to go through right now, it goes on as smoothly as possible, because like I just said, there's so many things that can go wrong with that mortgage if it's not done right from the very beginning. So that's why it's the life of the mortgage loan. I'm going to turn it over to my good friend Brenda Clem, who is so knowledgeable in the mortgage industry. She has taught me so much. Happy to call her my friend and co-author of this book, and she's going to take you through the next chapters after that mortgage package arrives at the lender.
Thank you, Linda. So we're going to go ahead and talk about what happens. And as Linda mentioned, there's a lot of activity and coordination from the time that the borrower finds the house, working with the real estate agent, getting all of the title commitment prepared, coordinating, getting the purchase package over, and the purchase documents coordinated to the lender. The lender, of course, is issuing a mortgage on the property. And we now are going to step into what happens when that loan package, all of the documents have been executed. and the package is now going to come back to the lender from the settlement agent. So there's a good possibility that that loan is going to continue to be held by the lender, or it might be serviced by the lender and they might just sell off the servicing. So the settlement agent, as Linda mentioned, is going to conduct a post-closing review of all of the closing documents prior to returning them back to the lender, which happens about 24 to 36 hours after closing. And as she mentioned, they're also going to remit back those escrow checks so that the escrow account can be established and other disbursements are sent off, such as the payoff and any other items that needed to be paid for, maybe for an appraisal or other types of ancillary services. The lender also has a post-closing department. So the settlement agent has post-closing, the lender has post-closing. And that lender's post-closing is going to review the entire closing package for completeness, to make sure there's no missing signatures and to make sure that they got all the documents back from the settlement agent. As we are moving deeper and deeper into having a full electronic file, COVID has really pushed us as an industry in that direction, enabling the documents to be transmitted electronically and through secure portals between lender, settlement, and other third parties, and also enabling the consumer to be able to electronically attach their signature. So we have seen some expedited processes, but we still want to make sure that for those that are closed in a hybrid where you're electronically signing and wet signing some of the documents, we want to make sure on the lender side that we have all the documents there, because we have to make sure that we've got that original note. We need to get that transferred to the collateral custody department. Post-closing also has an obligation to notify their secondary marketing delivery and let them know that the file is defect-free so that it can be allocated for loan sale. Loans are packaged and sold individually or in bulk, and we'll get into that a little bit later. So we have a number of investors out there, such as Quicken, Chase, Fannie Mae, who buy loans, and as most of you are aware, we also have Fannie, Freddie, and Ginnie Mae, also called the GSEs. So there's, again, a lot of activity coordination going on here. Tony, next slide, please. The due diligence review is really done behind the scenes. The consumer is not aware that this is happening, but the lender is. They're an investor that they're selling the loan to. Also could be, you'll hear the term aggregator, and there's coordination back with the settlement agent to let them know if any of the documents are missing, then there's any critical documents that need to be corrected. So this is all kind of behind the scenes from the borrower, but this process in due diligence really focuses on the value of the real estate and the borrower's ability to repay that loan. In the beginning process, when the borrower was obtaining the loan, we have qualifying them for the repayment of the debt, and that due diligence that happens then as we review income, asset appraisal, and we look at what is the value and what is the likelihood that the property will maintain the same value in the event that the borrower defaults. So that's kind of that credit qualification. This on the backside is looking at the due diligence review of the acquirer of the asset. So we're going to refer to them as the buyer of the asset, and whether they are purchasing one loan, whether they're purchasing a bulk of loans, there's a review that's done to make sure that that loan file and the mitigating any risk associated with that is a very important part in how that loan gets priced. So the loan level due diligence can be conducted on an entire pool of loans. If it's an acquisition, which is what we're talking about in this stage, every loan gets reviewed. And as you can see, some of the statistics here, the average cost of due diligence review is $600 to $800 per file. If we have any defects that are noticed during this review, and that cost is derived from the lender having to go back, contact the title agent, work with the borrowers to get any of those documents corrected to ensure that that loan is then available for sale. So we're going to move on to the next slide, and we're going to talk about the sale of the loan. And again, this is all behind the scenes. The consumer is Their notification is when they get a hello letter that says, hey, your loan has been sold. I need you to make your payment to someone else. But most lenders are going to package and sell their loans into the secondary market. It's how they make money. If your loan is sold, one of two things are going to occur. The lender may just sell the servicing, whereby you will continue to make your payment to the lender or a new entity, or the lender may sell your loan, including servicing, and then you're going to make your payment to someone else. So again, talking about kind of the hello and goodbye letters that you're going to get. Goodbye letter is, you know, you've got your loan with ABC Mortgage, but it's, you know, been sold to Freedom Mortgage, and that's who you're going to make your new payment to. Scammers we've seen are trying to trick you into paying them instead of the real loan servicer. So that's one of the things that we are cautioning folks to be aware of. There's a lot of cash that that is freed up for that originator in selling their loan. So when, for instance, if I sell my loan, whole loan, to another investor, I'm paid the entire principal balance of the loan plus a fee, which allows me to turn around as a lender and relend to someone else. We have larger pools. We have larger vendors out there, such as Fannie Mae and Chase and Quicken, who sell in very large pools. They also acquire servicing and package loans into other types of conduits, such as mortgage-backed securities. And 39% of all of the loans in the US are owned by a private bank, a credit union, or an asset-backed security. So that's a pretty staggering amount of loans out there. I think the latest statistic was there'll be about 3.9 trillion in mortgage originations this year. As Linda mentioned earlier, the purchase market is just booming right now. So next slide, please. The secondary market is where mortgage loans and servicing rights are bought and sold between originators, between aggregators or securitizers, and investors. So we have Fannie, Freddie, we have hedge funds, we have the GSEs, pension funds, which are all buyers of secondary mortgage loans, secondary market loans. When you take out a loan, when you go to your local lender or mortgage company, that loan is underwritten and funded and typically serviced by that bank. And the bank has the ability to use their own funds in order to make that loan. So if you go to Chase, Chase has lots of deposit funds from folks who bank with them, and they just turn around and relend that money, and they pay back those deposit customers in the form of interest. So when you are an aggregator or a correspondent lender, you operate off of warehouse lines of credit, and that's how you are able to turn around and lend. Loans are often backed by Fannie or Freddie, and there are, you know, an aggregator also could have thousands of similar loans that they pool into mortgage-backed securities. Secondary market was established in 1970, and prior to that, only larger banks had the extensive funds to provide mortgages, usually for 15 to 30 years. So prior to that, potential home buyers had a difficult time finding mortgage lenders, and there was a lot less competition than there is right now. And interest rates, when I got started in this industry, were like 17.5%. So you look at the 2.75 interest rate market that we're in right now, and it's just staggering. In 1968, a Charter Act solved this problem with the creation of Fannie and Freddie. We're going to talk about a little more about them. Those government-sponsored entities were able to buy mortgages and resell them to other investors, and that has created a very fluid market that we operate in. So again, there are three major players in the GSEs: Fannie, Freddie, and Ginnie Mae. And they are all either directly or indirectly associated with the federal government. After the subprime crisis, individual investors grew unwilling to risk their capital in mortgage-backed securities. So the federal government had to step in to fill that void with a secondary mortgage market. And that stopped rates from skyrocketing to a place where hardly anybody could afford to own a loan. Fannie Mae, as you've heard, is the Privately owned corporation chartered by Congress. Fannie sells stocks and bonds to raise money to buy conventional mortgage-backed loans. And the Veterans Administration and the Federal Housing Administration loan programs are mortgage insurance programs that ensure mortgage loans are made by lenders that Fannie does deal with in the type of secondary mortgage market. And Fannie is the leading purchaser of mortgages in our current market. Freddie Mac is a privately owned corporation that also provides a secondary market for mortgages, and it sells bonds to help raise purchase funds in order to fund those. So as you can see here, 61% of all U.S. loans are held by a GSE, and those are pretty staggering numbers. That the Fannie Mae and Freddie Mac have been in existence since the 70s. Right now, they are still trying to determine through FHFA what's going to happen with them. We'll see probably a decision made after the election, but right now we're not sure. Playbook is kind of governing what happens with them. I think they would like to go back and become private entities, but we'll see. Chapter 10 is the first-time home buyer, and we really have an opportunity in our current market to reach out to those underserved individuals who are kind of in that low to mod borrower range that potentially could be buying a home for the first time in their life and maybe within their family. Maybe they've been renters for years and years. So what is the definition of a first-time home buyer? And that's anyone who has not owned a principal residence in 3 years. They qualify as a first-time home buyer. Grants and specialized programs for first-time home buyers are available in cities and in every state across the U.S. You've heard of the housing finance agencies. One exists in every state, and they are the primary program that provides down payment and or closing cost assistance in a variety of forms, including zero interest loans and also deferred payment loans. The adjustable rate loan is important, and it allows the borrower to get in at a lower start rate, but with rates as low as they are right now, a 30-year fixed is probably easier for them to budget, since the only change they're going to have in their monthly payment is going to be in their impounds for their escrows for taxes and insurance. Fannie Mae is the primary funding mechanism for FHA and VA loans, and that's designed to assist first-time home buyers, and the veterans can obtain their funding with zero down payment. There are great first-time home buyer programs that now allow new home buyers with limited resources. The biggest obstacle that most first-time home buyers have is coming up with down payment assistance and closing costs. And again, the housing finance agencies and other first-time homebuyer programs have come up with forgivable seconds and sometimes even thirds that you can do for property renovation. Next slide. Borrower default. Our industry is in kind of unprecedented times right now, unprecedented times with all of the forbearance that has happened due to COVID. And back in March, when all of this was hitting, an impact was made on our mortgage market of about 8.5% of all mortgages were delinquent or requested forbearance due to COVID. Of all of the folks who have requested forbearance, and there were over 4 trillion of them, we are seeing that 30% of them still made their mortgage payment in April, and about 35% of them made their mortgage payment in May, even though they had requested forbearance. So the numbers are somewhat inflated. The recent numbers from last month, that 7.5 actually has dropped to under 7 in delinquency. So that is wonderful, which means borrowers are either reaching into their savings or maybe they were furloughed initially, they're back to work. Possibly they requested forbearance because they had a reduction in pay, but they are back to work full time. And so they're finding that they're still able to make their mortgage payment which is great for our industry. Many lenders and servicers allow a grace period during forbearance, so they're not penalizing them with late fees. At the end of August, they will go back and start looking at the borrowers that did request forbearance and see which of them need to be put on some type of maybe loan modification or adjusted repayment plan. But there are provisions in the CARES Act which allow borrowers with federally backed mortgages to request the temporary loan forbearance up to 180 days. So that will be the end of August when that matures. And then they have the right to apply for another extension of 180 days, but they must show that they've endured a hardship due to COVID. So hopefully we'll see, folks continue to be able to make their mortgage payments, and then those mortgage assets and those investments will not have the performance issues that we're kind of anticipating. And I'm going to turn it back to Linda, who's taught me a lot about the title side of the business. I've not spent my career there, so she has been wonderful in the past couple of years that we've known one another, teaching me everything that happens on that side, which is incredibly, it's just very interesting. I had no idea, and I continue to learn so much. So appreciate everything that you're doing for me.
Thanks, Brenda. So going back a little bit, you don't have to change the slide, Tony, to the default. All of the things that start from the beginning of the loan, through the closing, through the sale of the loan, if the borrower defaults, which has to be one of the most tragic things that can happen to someone, if they default, especially if they're going through something that's COVID related, that's even more of a hardship on them. If the processes weren't followed in the beginning of the loan on the title side, then that lender's not able to file a foreclosure action against them. Foreclosure's probably the worst word, but a lot of people in our industry do make money off of that. I'll give you an example. If the borrower has bought a house from a seller, and the seller had 4 loans on the house, a couple of judgment liens, a municipal lien, a home equity line of credit, and nobody has checked to make sure that those liens are actually paid off. So let's take the home equity line of credit, for example. The lender, has a checkbook that they give to the borrower. Then that seller, the person who owns the house, has sold the house, they still have that checkbook. If the lender does not close out that account and file a release of lien on the land records, that borrower, who's now the seller, but he was the borrower at the time of the home equity line of credit, can write out a check and borrow money against that loan. He doesn't own the property anymore, though, because he's already sold it. So what happens then? That lender who had the home equity line of credit remains in first lien position. The new mortgage stays in second lien position. So unless there's follow-up afterwards to make sure that all of those liens have been cleared from title, they cannot foreclose on that property because they don't have first lien position. So it all interplays with each other. The title side has to do their part. The lending side has to do their part, but we all have to work as a team together because these borrowers, this could be, I think the statistic that Brenda and I had found out was the typical homeowner, excluding all of us in the industry, owns a home only 5 times. So they transact 5 times in their lifetime on a loan or live in a home of their own. They're not experts on that. We're the experts that are supposed to guide them through the process. And we all have to work as a team to get them through that. Now, if the American dream is to own your own home, the ultimate American dream is to pay off your loan. So at the end of the loan cycle, the mortgage cycle, the borrower then pays off the loan either through refinance or through, ending the term of their loan, receiving some money and paying off their loan, but now they're going to own their home free and clear. So what happens at that point? Now, 30%, 37% of all homes in the United States are mortgage free, which is great news, because that is truly where we're all trying to be in our lives, is to pay off our loan and be debt free. So the day has come. What happens? They pay in, they send in their final payment. The note gets marked paid. The mortgage gets marked paid. That gets sent back to the borrower. And the lender's responsibility statutorily is to file a release of lien on the land records. In all 50 states, it's a different amount of time that that lender has to file that document on the land records, but that's the only thing that is going to extinguish that mortgage from the land records, so that that person who owns it now, free and clear of a mortgage, can transact on it, either get a home equity line of credit or sell it, pass it down to their children. The only way they can do that is to make sure that they have clear title. So that's the final part of the loan process, is paying off that loan and owning your house debt free, or paying off the loan to buy, downsize, or expanded family, move out of the area. But at this point, the loan is paid and it has run its life cycle. So here you can download our ebook. I know you can't click on that link on your screen, but you can download our ebook if you write it down. I believe that Tom is going to send out some information. This is my email address and Brenda's email address. If you have any questions, please reach out to us. Again, I've been in the title business for 30 plus years. Brenda's been in the lending business for 30 plus years. If we don't know the answer to your question, I'm sure we can find the answer to your question. Tom, or does anybody have any questions?
Well, appreciate the segue, Linda, and appreciate you and Brenda going in great detail, kind of overviewing the different chapters in the playbook that you both created. So as you mentioned, while can't click on the link currently, rest assured, attendees, we will have that link direct for you as part of the follow-up correspondence, that you can access a copy of the ebook for yourself, and be able to load Linda and Brenda up with any questions that you have based on your findings. But to Linda's point, I want to extend that opportunity back out to our attendees. We've got about 7-8 minutes left on this discussion. So any questions that you have, feel free to enter those into the chat or Q&A functions. I'll be able to verbalize those on your behalf. In the meantime, I had kind of a question or two for you both as far as creating this playbook. Maybe in a little context too. So you can provide us some guidance, like how long did it take you to create this? And I guess, when did you start and when did you finish?
It took a while.
It took a while.
Probably it took us back and forth, maybe 5 or 6 months to put this together. A lot of research. So what we presented today is really kind of, this overview in 40 minutes. That if you order a copy of the ebook, there are two kind of driving reasons of why we created it. Number one was, Linda has very deep domain knowledge on the title side, because that's where she spent her career, and me on the lender side. So we wanted to use this as kind of this cross-reference tool for folks who were either, like for me, understanding what happens on the other side of the wall where she lives has been great for me. I will probably never work in that side of the industry, but it's good for me to be able to understand what happens when, between the realtors and title and just all of the layers that happen in that industry. The other thing is that we looked at this and we've approached Alta with this. They were championing us to go to DC and present this to Fannie and Freddie as a tool for the first-time home buyers. We've reached out to National Association of Realtors and some other industry committees to say, this is not only a good learning tool from an education standpoint, but for folks who are new to the industry, here's everything that happens outside of what you do at your desk or in front of your laptop every day. That's in a digestible format. Linda?
Yeah, it's the ebook's very visual. I think the graphics, after we put everything together, the graphics gave us a little bit of difficulty, but we got it nailed down. It was actually Justin Ailes, who was the head of the lobbying for the American Land Title Association, actually put me together with Brenda and said, you guys have to meet because you know so much about the title industry. Brenda knows so much about the mortgage industry. And Brenda and I, you know, we had seen each other, we linked in together, and then we're in this conference room and we're like looking at each other across the room saying, wait a second, you're the person I need to speak to. I was sitting down at that conference with some longtime people that had been in the industry on the title side, own their own businesses, own one of the top 20 title companies in the country. And I looked at him and I said, do you know what happens after you package up that loan and send it to the lender, and how you're playing an important part in putting together that package? And he looked at me and goes, I have no idea what happens after it gets sent off. And so you saw Brenda, and she kind of like cringed, like, oh my goodness. And we realized that we definitely had some information to share with people. And like I said, she's been such an influence on educating me on the lender side. I can't talk the way she talks, but I can hold my own now on a conversation.
You're good.
Well, kudos to you both. I mean, the book, it's the visual aspect is extremely, important. I think today more than ever, where people tend to have much shorter attention spans. So I think a lot of the graphics and the stats they have behind that, really jump out and support a lot of the findings. And I couldn't agree more. I mean, there's so many people that work within this industry that are particularly siloed to, their role, their task or function, and have not the slightest clue of how all these different elements of the process, especially once the loan goes to the closing table, what takes place until that lien's actually paid off. So
Right.
I agree. I mean, I think it's such a key resource, especially to those that are newer to the industry, kind of getting a full range perspective of how this all works.
Right, absolutely.
Thank you. And we've seen, we are in unprecedented times with all of the refinance and purchase volume that's going on. And just every day lenders are reaching out. We're hiring 450 people. We're hiring 1,000 people. Well, we all know that they don't have mortgage domain knowledge or title knowledge. We're just grabbing you because you're a warm body and you're vertical. So, this possibly could be something that would benefit them. We'd be happy to share.
Yeah.
Absolutely. So I've got to ask, I imagine quite a bit changed once, COVID really took grip of our industry and, the world at large. I guess what stands out from both your findings, either generally or maybe from a process standpoint after the loan close, that's changed most drastically in the current COVID environment?
Linda, I'll let you take that one.
What's changed most drastic? Well, my expectation, there were so many people that have been laid off. I didn't really think that the real estate market was going to go anywhere during all of this, and it just boomed. I mean, we've seen numbers that are really astronomical. On the title insurance side, the title companies and the attorneys were always still working. They were essential workers in most states except for the state of Pennsylvania for a little while. So nothing changed for them. It just got busier for them. Because of the refinances, it requires seeing an uptick in title curative where that original lien was never paid off and now they can't close it. So they're looking to us, which is one of the services that we offer, to locate that previous lender to get the document signed so they can move forward with closings. We've seen a huge uptick in that because the refinance market has boomed and so many orders are going through the system that there are, 17% of them have problems. So obviously you're going to hit, out of 100, you're going to hit 17 loans with issues that need to be right away. They want it yesterday. So we've definitely seen an uptick in the title curative business due to that factor.
Excellent. Okay. And then one last question I have for you both. I'll start this off with Brenda since you got put on the hot seat for the last question, Linda. You know, for, I guess, in the feedback that you've received from the findings of this book, or even on speaking engagements that you've done around it, is there any misconceptions maybe about the loan process after closing that you both have had to dispel, or that you're kind of surprised by as far as being considered, you know, maybe common knowledge, but not actually true?
So, you know, I have spent the majority of my life in the back end, the capital markets, warehouse, secondary. So I'm always kind of behind the green curtain, as I call it. And, you know, then my free job to our industry for the last 15 years has been as an evangelist and advocate for e-notes and e-mortgages. That's probably what I'm better known for, the thing that I do for free. But, you know, all of that as a whole, you know, our industry, we've tried desperately to have an expedited process. And when Rocket Mortgage came out, you know, with we've got this wonderful process, you can take your application online. And so it was kind of the catalyst for moving our industry forward to have a more digitized type of transaction. And it really wrapped around that consumer experience. So you look at folks who come into this space and into the mortgage space who are really tech savvy, but don't understand mortgage. And they're like, well, I'm over here building a bot or a widget or an app. And it's like, well, that's great, but how do they use it? How does that make this better for the borrower, for lien release, for secondary? And they're like, I don't know, but it's really cool and it's really shiny. So I think from that standpoint, I mean, I work for a technology company, and we have just talent that's amazing, because I can't spell IT. I mean, I freely admit that, but I understand what happens on the business side. So, you know, this is a tool that I've taken to our education department and said, you know, let me spend an hour with our staff and use this as an education resource so that people can start connecting the dots and tie it all together.
I had the same thing happen at my office. Excuse me. My people back, so we're owned by Covius, and the people back in Colorado had downloaded the book, and they read through the book, and the head of our IT and compliance, he was like, this book was able to bring everything together from all different sides of the transaction. And it was such a good thing. Do you mind if I share it with the team? Because they don't know what happens. They just know their little, like she said, their little corner of the world and what's happening there, developing apps or widgets or whatever. They don't know the whole thing. So even my company has downloaded this to use it as a learning tool for the folks back at Covius.
No, you both make great points. I mean, it takes me right back to my current role, and I've had, you know, multiple conversations with partners in the past too, to your point, that have, you know, this great technological advancement that can really help the industry. But you've got to be able to relate it to seasoned pros within our industry who need to understand, how does this help me within the mortgage process, and speak that language. It's such a almost unique code that we end up speaking within this industry, and all the acronyms that get thrown around. You've got to be well-versed to kind of make that connection to long-standing industry professionals who, you know, can easily relate back to a fully paper day. And kind of, you know, understanding the how and why behind some of these latest technological advancements, and, you know, how we digitize the process. And Brenda, to your point, I mean, I still remember when that Rocket Mortgage commercial debuted during the Super Bowl, and that was like the jumping off point from there. And I feel like every year from here, it's, you know, is this finally the year that we, you know, cross over the hump on that digital transformation, especially on the closing side? And And I think you both probably agree COVID, if anything, has kind of accelerated that process again.
Oh, absolutely. Yeah. I mean, it as terrible as this has been, it was finally kind of that shove that we needed to say, we need to meet the consumer and everyone involved in this transaction wherever they are. And this is forcing us to do that. So we are. We're committed to do that.
Excellent. Well, on that note, since coming up on the top of the hour here, I want to thank you both for, just creating this book. It's extremely insightful, and, taking the time out to share your insights about it with our partners and our members today. Really appreciate it. And I hope our attendees take the opportunity to download the ebook and, leverage it as a wealth of resource. And I'm sure both Brenda and Linda would be happy to share additional insights if you have any questions from it.
Absolutely. Yep. Thank you for the opportunity to present this today. I think this is the 4th or 5th time that we've done this. And, as Linda mentioned, we've shared this out with, friends and with our companies. And I like where it's going. I think it was needed, when she and I first met, and it was like, oh my goodness, let's put our heads together. I think we can come up with something great. And I'm really proud of the work that we've done.
Yeah. And thank you guys for having us today.
Absolutely. And you both should be proud. You might be getting hit up before you know it for a part 2. Well, again,
in 4 to 6 months.
There you go. We'll let COVID settle down first.
Exactly. Thank you, Tom.
Well,
thank you, Tom. Appreciate it. Thank you to TMC.
Yep. Yes, thank you.
Thanks. Have a great afternoon, everybody.
You too. Bye-bye.